All right. Well, welcome everybody. We're really just getting excited here for this podcast for show we call Truth and Equity. If we haven't met yet, my name is Minor Ramos. Most people will know me as the principal defender, as I'll explain to you in a little bit. Why that came about. But excited today to talk about what's going on in the mortgage, real estate, lending space. And with us, I'm going to go ahead and do a quick introduction of our panel. And then we have a guest speaker today, and I'll introduce him as well. But this show is being brought to you from Velocitas Banking, right? And, one of the co-founders of Velocitas Banking is L Mills. L Mills, AKA the prophetic financier, just a long history of the financial space, his own companies in New York, Florida. He runs also the Empirenomics for financial intelligence. He's also my mentor, so I'm proud to have him on. So welcome, L Mills, and I'll let you have a word here in just a few minutes once we get everybody through. We also have Lauren. Lauren, known as the solutionist. She's in the credit space, and we'll have a minute to have her introduce herself and talk a little bit about what she does and why it's so special. And then of course today as our guest, we have Greg Matthews. He comes to us with a certified mortgage planners. And we're gonna talk about this idea of truth and equity, and really these are all the key players. As you're gonna see as we develop this, you're gonna understand why it's so important to have the mortgage professionals, the credit professionals, and then when we go into the idea of the velocity of money, the movement of money, and we go into that. Before we get started, I wanted to give you a quick, very, very quick story about why they call me the principal defender and why we're talking about the truth and equity today. So most of you have been or are involved in real estate, mortgage. And so I'll tell you something that happened to me. And this is where this idea of velocity, the velocity of money, the movement of money, just kind of, I became so thrilled with this idea. And several years ago, I inherited a property. It was basically a vacant land. And I bought it for about $1,000, right? And when I bought the property, just thought nothing of it, just pay the taxes, have somebody mow the lawn, and, but then I moved out of state, and then right around that time, Southwest Florida was just really growing at about a 38%, growth rate, right? And so I started getting, people from, Canada and Germany asking me, hey, if I wanted to sell my lot. I was like, I don't want to sell my lot. It's like, it's an asset, right? I want to keep that on there. But very, very quickly, I started getting offers for like, $6,000, $8,000, and then up to the point where I got it. I got an offer for $15,000. Remember, I got this property for $1,000. Somebody's offering me $15,000, and so I realized at that point that the way that money moves is by us exchanging something. And so I decided to go ahead and sell it. And when you think about it, I'm getting a 1,500% return on this investment, right? And then this is where people's jaws usually drop, because about a year later, that lot sold for about $150,000. Now, truth and equity would say, man, Minor, you really missed out. But the truth is, without me moving and first of all acquiring the lot and then selling the lot, that would not have moved. That lot would not have gone to $150,000. So this is where this idea of really overstanding, in Empirenomics, we talk about overstanding, really, getting that in, your head and understanding exactly what's going on with the market, so that we can then have what we call social mobility, right? Social and economic mobility. So the reason why I tell you that story is because that'll give you an idea as to why I'm so obsessed with looking at financial structures and figuring out, where does one thing, move, and how does everything connect? So to get us going with our conversation today, I wanted to bring in Lauren. Lauren, as I told you, we she's known as the solutionist. And I really want her to talk about what's the difference between, in order for people to move, and have that social economic mobility, when they're talking about mortgages, when they're talking about, real estate, what is the difference between just a profile? I mean, that's really the important part on credit, and what the FICO score versus, the profile. So Lauren, if you could kind of talk to, because that's kind of where everything, starts. And then, we'll go over to Greg.
Well, hello. I'm Lauren Bilgero, aka the Solutionist. I love how you got right to the point about the difference between profile and report, especially as it pertains to real estate and the mortgage space. I always like to first come back to, report has such a negative connotation to it, right? Our entire life, book report card, quarterly report. It's not, it doesn't have a happy feeling about it. You've already lost control over it, right? We like to kind of change that to profile. Consider a dating profile. You're in control of the information. You get the opportunity to put in your best foot forward and, really display what you want your significant other, your mate, to find. But if we change that to the credit world, it applies perfectly. We're choosing the information that's going to maximize the fundability aspect of the profile, but we're also making sure that we're putting our best foot forward or translating data so that it does portray the best foot forward. Whereas with a report, it just is, and that's it. You have no control. You've lost that. So I refer to that as a profile because it gives you a sense of power. Also for profile, we have the opportunity as consumers to populate and display the information that we want seen about ourselves. The problem is consumers don't know that this is within their rights, and it should be within their knowledge, although it's not yet, to be able to populate this information. And myself and Total Solution Trust are really, giving this movement force as we can teach as many consumers as possible to know that they have the power to do this, especially when they're looking into, buying real estate or buying an investment asset, so that they know that these things are within their reach. And it's a really good first step to take, especially if they have to use any leverage on their own personal Social Security number to make sure that their personal profiles are set up. Does that answer your question appropriately?
Yes. Absolutely. So basically, what I'm hearing is that, I know Greg, when he's looking at, at files, he's looking at that FICO score. It's what drives everything, right? But what you're saying,
that's you as the underwriter, Minor.
But Lauren, when she looks at it, she's like, even though you might have a 700, 800 FICO, there's still some stuff in that profile that could really.
It's the fundability factor. Absolutely. A FICO score is just it's a solution to an equation based on a circuit package that a corporation bought. There's FICO 3, 5, 7, 8, 9, 10. There's all different types of FICO. So when we refer to FICO, okay, well, which one are we referring to? More times than not, it's the general FICO 8, the regular score. But it doesn't actually take into account the bigger picture, the entire profile, the name, how many addresses, phone numbers, what's the status on the account? What are the back markings? The entire quality of the profile. Instead of XYZ is there, it meets a certain percentage of the total report identity. It goes into much more than that. That's why you find a profile built for fundability optimization is different than one just built to optimize a 3-digit number. It's a lot more richer. The 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 accounts have a longer time associated with them. So it reflects positively in more than just one measurement.
Gotcha. That's awesome. It's good to know. Last question for you, Lauren. Then obviously, somebody, whoever's, listening to our podcast, whoever, might see this as a webinar, Total Solution Trust exists for the purpose of that. This is where you come in. You just, let everybody know how you can help them and how they can keep in touch with you.
Yes, myself, AKA the Solutionist, and Total Solution Trust, we help people to restore and to remaster their credit profiles so that they can make the big purchases they need to grow. Generally, we refer to a home, or there's a car, or a very large repair on a house. But also, more and more coming into light is the opportunity to buy cash-producing assets. And you're going to be getting into that in equity, so how perfect. So,
I like
yes, anybody who's looking to move to real estate or knows that their profile needs work, it's best to get on it right away. That way everything has time to get removed and you can move through the process.
And I appreciate you sharing that. So basically what you're saying is cash producing assets, because everybody thinks, right, that
everybody thinks.
Yeah, yes. the biggest thing they own is their home. And the fact is that the home doesn't produce any cash flow and at all, unless, you do something else with it. Right. So Lauren, thank you so much for, for being on today. We may have to have you chime in a little bit. Yeah. And so
thank you.
Absolutely. So now let's go ahead and, our guest for the day. So let's move over to Greg, because this is kind of the part where kind of everything starts. I mean, as you're seeing right now with the interest rates the way they are, and just to help people, really understand the fact that if they're sitting on a property where, they might have $200,000 in equity. I mean, just think about the fact that there's probably millions of people that are still sitting on 5% loans from 6 years ago, right?
Right.
What they could do is really, start looking at that. We call it triple indemnity. We're going to get into that when we talk about the truth and equity portion. But Greg, give us a little bit about what you do and the products that you represent.
Yeah. So I wanted to touch real quick on to what Lauren said. What I hear a lot about with, unfortunately, is instead of using common sense lending, we're using guideline lending. And that's what we have a lot of issues in the mortgage business, is that I have people that I look at the loan, I look at, let's say, the profile, the full scope, and I say, does this person have the ability to repay? Now, the guidelines are there and built to try to create that, but each individual person has a different ability to repay, and that score doesn't really tell the full story. So, I really appreciate and empathize with what, Lauren's saying on the full financial profile. Unfortunately, like you said, we're looking at that FICO. That's what we have to go off of with these guidelines. But I do get upset sometimes we don't have common sense lending. But yeah, I'm a residential mortgage loan originator minor. We obviously, met a few years back in the mortgage business. I'm now working for a company, Certified Mortgage Planners, up here in the Lake Mary area of Florida. We specialize in all sorts of different lending. Obviously, we do the conventional Fannie Mae, Freddie Mac, FHA, USDA, VA. For self-employed borrowers, we also have bank statement programs where we're working off of a self-employed individual's cash flow into their business or their personal bank account, and using that cash flow in order to qualify them. We also have some private money lending in-house that we do a little bit of that. Renovation loans, construction to perm. The only thing we don't do is land. So that land that you bought, we wouldn't finance that. We refer that out to other people that we have partnerships with, but we do most of the lending under the sun. And yeah, so that's us.
That's awesome. That's good to know. So, and so you mentioned the self-employed because, think about it. We're in Central Florida. I mean, there's a lot of people, right, that, that are going to be, they are
so many small business owners here. Yeah.
Yes. Yeah. Now, are you licensed in any other states?
So we're only licensed in the state of Florida and Hawaii. So if you want a condo in Hawaii, we can help you out. We actually have a loan officer that she's stationed out there, but no, our company's Florida based.
Awesome. Yeah. Greg, another question for you. What are you excited about right now, man? Like, what's exciting you about the industry or who you're serving, or what's going
Yeah.
on?
Oh, and I did want to, obviously, with the topic today of being equity, I wanted to piggyback on what you were saying about people having the most equity in their homes. Values have been on the rise, right? I mean, we've seen home values continue year after year ever since the Great Recession recovery continue to rise, and people were still in those 4, 5, 6% interest rates. Now's the time where you can get a lower interest rate, tap into some equity, and whether it's debt consolidation in a sense where they're paying off some of the debt that they have, starting a IRA, or investing in an insurance product, or starting with a financial advisor. I mean, there's just a multitude of things that people can do to not only protect themselves, insurability, but also build for their retirement on the investment side of things that they're not getting because they're sitting on that equity in their home. And so there's a ton of opportunity in that. Interest rates, as we kind of talked about, were really, really low for quite some time through 2020. They've trickled up a little bit, but still at insane lows, right? Still in the low 3% range. Huge opportunity for first-time home buyers that have been renting. I'm really excited to have a few people right now that have been renting for a few years. Minor, they've spent $1,500 a month in the last 3 years. That's over $36,000. I mean, my math's probably off, even closer to 45 more that they spent on rent when they could have been, investing that in a down payment and monthly payment, building equity in a home. And so now helping those people, achieve that dream of home ownership has been great. But yeah, it's an exciting time in the market, and we're actually having the reverse problem of 2008, 2009. Everyone's thinking, oh, COVID was going to create a real estate bubble. We don't have foreclosures. We don't have a surplus of homes. We have a shortage of homes on the market. People are putting homes on the market and getting multiple offer situations within 24 to 48 hours, which, is a little scary that there's not a lot of demand there, but having excess demand is a lot better than having excess supply.
Gotcha. Oh, that's awesome. So thanks for the update on the markets there and what's going on. And
Sure.
the last question for you, how can what's a good referral for you, and to our listeners, how can they get in touch with you? Obviously, we thank you for being on the show today.
Yeah, thank you.
What's a good referral, and how can they keep in touch?
Yeah, so a great referral for me, Minor, is someone that real estate agents are the best because they're working with clients directly, and a real estate agent that wants a loan officer that they're going to have their personal cell phone number. They can shoot them a text, give them a call on the weekends or after hours, be available, build a relationship with that person so that they can call me and say, hey, Greg, what's really going on here? What can we do for this borrower? Because, real estate gets tricky. It always seems like it's going to be an A to B straight line. It goes A, B, C, D, jumping all over the place. So, having a great partnership with a real estate agent, a mortgage broker is hugely important. And then on, the referral side of a direct to client, any clients that are looking for education, we call ourselves certified mortgage planners. We are comprehensive mortgage planners. We're not get you in the door, get you a loan, and get you out. We're going to go through your credit. We're going to coach you on those things. We're going to talk about what you do with your take-home pay. We're going to introduce you to insurance and financial advising individuals business professionals that can help you out, estate planning attorneys, things like that, things that you need for your whole scope of home ownership. We're going to be able to be there to cater for you. And then to get in touch with me, my cell phone number is best, 407-619-2488. And then also you can follow me on Instagram at Greg Matthews Mortgages. I have a lot of content on there, so connect with me on Instagram. Thank you, Minor.
Awesome. Yeah, absolutely. And, thank you for joining us today. Again, our guest, our guest today, Greg Matthews. So right now, you touched a little bit on the, the truth and equity that we really want to talk about. So I want to bring in Mr. Al Mills, also known as, the prophetic financier. And what we're going to really do is we're going to like unpack this idea, because we started with the credit, very, very important. We went into the mortgage and combined that with, with real estate and what's going on in the market right now. But you did touch on the fact that, insurance and some insurance products and Velocitas banking really is, that piece of it, with the other side, the wealth building part. And the story that I told you about, the land, this is, everybody talks about velocity banking. Everybody talks about infinite banking, but they're missing a big piece of that, right? Because we're not talking right now about that segment of the market that centers so much on that scarcity mentality. There's a few figures out there. I don't want to say their names, but everybody knows, what they teach, kind of like, buy term, invest the difference, and, eat rice and beans and macaroni, and don't go to Starbucks because, right, you gotta pinch pennies so that you can move forward. And really that really sounds a lot like scarcity. It doesn't sound like abundance, right? We want to talk abundance here. And so when we take all the trajectory, the credit, where do you find that, that loan product, that's going to get you, the property that you need. And now, being able to move forward into this space where we can create, build, and we talk about flow instead of budgeting. We talk about flow. We talk about, having, cash flowing assets. Now I want to be able to introduce you to Al Mills, the prophetic financier, so we can talk a little bit about, this idea of, truth and equity. So help me welcome Al Mills.
Hi there, Minor. Hi, Greg. Hi, Lauren. How are you? Thank you guys for having me today.
Absolutely. So Al, what as far as moving and the idea of not keeping this, the capital that isn't moving, right? How do we get it to move? Where do we deploy it? And what are we doing with this so we could get, some equity?
Well, the first thing I want to kind of reiterate what Greg had mentioned in reference to folks with equity in their homes. One major fact that most don't know is that equity in your home is not appreciating in terms of earning an independent yield. A home that's fully leveraged or free and clear based on the appreciational rate in that area, the home's going to go up in value. And to kind of give you an example to that, if homeowner A bought his home $100,000 home all cash, and homeowner B using a 10% down payment and 90% leverage, but that market is a 10% appreciational rate, both homes increased in value by $10,000. However, when you look at the financial intelligence on that, homeowner A would have earned only $10,000 on his $100,000, which is a 10% yield, whereby homeowner B out of pocket was $10K and they yield $10K in equity appreciation. His ROI is 100%. So when you just understand that portion of how to evaluate cost versus appreciation versus equity versus yield, you begin to see the difference. Now, in second part to that is asset. Most people believe that their single family home is an asset, but we have to dispel that myth. An asset is something that pays you, very simplistic. A liability is something that you pay for. So is that single family home an asset to you? Based on a financial definition, the answer is no. Even though traditional and conventional thinking is that that's an asset, it's an asset on the bank's ledger because the bank is receiving a payment for 360 months. The borrower is paying out. So on the bank's balance sheet, that's an asset because they're receiving payments. But on the ledger of the owner, that's on the liability column. So you see the false premise of what an asset versus a liability is one of the major problems. And so us unpackaging this truth and equity, what we're needing to share with people is that, sure, this is the most expensive investment you'll ever make in your lifetime. However, most of the professionals that are surrounded in that space are not financial professionals. Coming from the background, I've owned mortgage companies. I was a correspondence lender for many years in New York City. And I also am a part owner of a real estate brokerage in Florida. Coming from my perspective, we've trained our agents, may they be mortgage originators or real estate agents to treat this as an investment and show people the dollar cost average, show them how they're going to see this years to come. If you should always buy a property with it in mind that if I had to rent it out, could it support itself without my primary participation? If everyone went into purchasing home that way, there would be a very few foreclosures ever happening because a person can just reposition themselves, put the property to rent, and then reallocate. But unfortunately, they purchase a dream, the American dream. And that's just exactly what it is. It's not a reality. It's a dream. It's a facade until you get the proper education. But in reference to the equity, back to the truth and equity, with that said, we're here to educate individuals, to show them how this is the greatest time on the planet right now to be able to extrapolate that equity and reposition it into an asset that can produce passive income. Because we've been focused on riches too long, but we have to look at wealth. Wealth is measured over time, and it has to negatively extract you out of the equation. So we want to show individuals how they can take their equity out of their home, work with a team like Greg, and basically reallocate that into an income producing asset that services not just itself, but also the underlying debt that they took out in the refi or the HELOC. And it becomes a win-win. And then couple that with the social mobility mobile that we use called Velocitas Banking, we can also create a legacy component to that. Did that make sense?
Absolutely. So,
Okay.
That obviously, when you talk about, creating assets, now that I think about it, that lot, and if I had the financial intelligence that I now have,
A lot of credit.
I could redeployed back then, imagine, get borrowing against it and redeploying it. But let's talk about, you mentioned that we could redeploy it. And in Velocitas Banking, the concept is this of having triple indemnity. And triple indemnity comes, because, you're, if anybody's sitting on, $200,000 in equity in their home right now, and they don't do anything today. And then let's just say that the market does crash in 12 months, 24 months. If they act now and have that money, where is their money sitting? In their hands. So it doesn't matter what the market will do later, that capital sitting in their hands for them being able to redeploy it as that truth and equity. So talk a little bit, Al Mills, about the triple indemnity with Velocitas Banking.
Sure. Well, let's go back to the equity. Equity, again, is an illusion. You can't touch it, feel it, smell it. You can't do anything with it. Most folks, to get it, they have to either sell the asset or go into what we would call negative debt, right? We talked about different types of debt or leverage, for another lack of a better word, is positive, neutral, or negative leverage. So a lot of folks, when they take money out of their home, what do they do with it? They do home improvement, they go on a vacation, they pay off credit cards. If you notice, they're all paying off liabilities. They're not acquiring more assets. They're just taking good equity and putting it into bad debt. That's a habit that has been formed. But the triple indemnity that we're talking about is that when they extract that equity out of their, I call it a time safe, a 30-year time safe, when they take it out of that and they put it into the Velocitas Banking, well, the very first protection they have is principal protection. That means that equity they took out and they deployed into a properly structured insurance policy, if you will, they will have the ability to have principal protection, which means it'll never deplete. It's out of the hands and the reach of lawsuits, divorce, bankruptcy, creditors, and it can earn interest free, which is a powerful thing, or at least deferred. That's number one. That's the first thing. The second thing is you can have a guaranteed preferred rate, which is outpacing the traditional bank CDs, MMAs, and the like, at a minimum of 4%, upward to 5% guaranteed, right? And then there's the third portion is predictability, is that in reference to the participation. Now, we all here speaking about finances. So just imagine that you are partnering with a mutual company, aka your insurance company. And instead of them having shareholders, they reward their policy owners. And so they share in their profits in the form of a dividend. And they pay that dividend back to the policyholder in the form of future premium payments. But it comes back to a nominal number of, let's just say, 5%. So at the end of the day, someone who participates in Velocitas banking just repositioning their equity from zero earnings. It sits in the time safe, earning zero interest. A matter of fact, it's a negative compound because of the inflational rate. And now with the country printing more money, it's going to be more hyperinflation. So they're putting it in a safe haven that they're going to get 10.2%, pretty much predictable. All right. And then the last bonus is that you also have the benefit of creating a legacy for your family where you have those high death benefits. So here's the question in the law of polarities. If you looked at your money, that money being locked up in the time safe, what is it earning you? Zero? Is it leaving a legacy for your children? That's uncertain. Why is that uncertain? Because that equity is based on an opinion of a market that you don't know what's going to happen a year out, 5 years out, or the like, right? That's what happened in '08 when the market crashed. People had equity, and equity doesn't dissipate. It just changes hands. That's all it does. And so back to Greg's point, to kind of build on that, there's a shortage of real estate right now, but there's a reason for that because real estate has 4 cycles. It has the boom, the flat line, the crash, and then the transition. So for those who are financially savvy and intelligent, you sell your properties at the top of the market and you buy at the bottom of the market. But 98% of the population buy at the top of the market because they're listening to the financial pundits saying that the markets are stable. This is a very simple consciousness. You always buy out of season. So right now, the astute investor would be fearful to purchase a home right now because the sellers are greedy. It's a seller's market. You wait. So the point I'm making here is there's going to be a shift. If you look at all the trends from 2008 to now, we've more than quadrupled those numbers today. So the reason there's a shortage right now is because the major players who was holding on to that inventory is getting out at the top. With the moratorium of foreclosures that's been happening since COVID, going back 10, 12 months, then the previous 10 to 12 months, you have paper on the books of major banks that are people are already 2 years in default, but they couldn't foreclose and even take legal action because of the COVID scenario. You're going to begin to see an onslaught of homes. All right. So the players are getting out now to get their cash out so that they can buy at the bottom in the transitional period. So this is what you see happening right now. And the Fed is going to raise the interest rates because they have to raise the interest rates based on the government spending. Remember, taxes is directly correlated to pays the debt spending of the government. Taxes pays that. So they're going to the Fed's going to raise the interest rates. As Greg said, they're starting to creep up, and they're going to creep up even more because they have to balance out. The LIBOR has to balance out. So the point here is that this is a great time for those who are into legacy building, who want to keep their homes for their later generations, but they also want to solidify the unsurety of what's going to happen in the future. They can reposition that equity into Velocitas banking and create legacy wealth, and also have the opportunity to invest into other things. But at the least, if reposition it from a zero interest earning to 10.2 with triple indemnity is a much more intelligent scenario, right? Now I would say that's a more smart and intelligent way of doing things, especially with interest rates as low as they are today. And that interest is tax deductible. So that's another benefit. When you do refi, the interest is tax deductible. So to fund your other opportunity, smart play.
That's awesome. It's a great summary and a great explanation of this what we call is the inefficiency of money.
Yes.
And now we're really just giving people the education to be at a point where they could bank better. Because Velocitas banking, aside from all the things that you mentioned, One of the things that when I look at a loan structure and I see people having $200,000 in any big bank account, and it's like 0.18%, right?
Sure.
That they're getting back, and then you look at it, it says like a service charge $9.99. Like, wait a minute, this is somebody's equity, right? Because
Yes.
that is a deposit. That is their equity. It is a deposit, an asset is on the ledger of the client, and it is a liability against the bank, right? So no, since we're talking about helping the bank better, but if just Velocitas Banking as just as a scenario here, if you had $200,000 of equity in your home, cash that out, move it over into Velocitas account, that's one indemnity. Then you have we're talking 20-25 times more than they're getting at the bank, right?
Yep.
And
absolutely.
then you have the wealth creation. But one of the nice things that's happening right now is, if we were depending on the person's age, because it is driven by a high cash value whole life policy, right? And one of the things that happens with that is, because we structure it for the borrower to be able to have access to a large portion of that capital, it does come with paid up additions rider that allows that value of that instrument to be worth, let's just say, 500,000 to $1 million, depending on the age of the person and the health of the person. So now think about the way that it would have happened before. If they didn't move that, there was no moving into efficient money or equity. If they became sick, well, they would have to, either dig into their 401k or whatever else they might have, or maybe sell the property. But here, a lot of the insurance carriers that we have allow them to use that, what we call the living benefit. Is something dramatic, something really hectic were to happen in their lifestyle. They have that really, really what we're talking about is quadruple indemnity, because now their health, they're able to draw into that from that policy to be able to use it while they're still alive. Mm-hmm. So, I mean, I'd like to, to have you kind of, go into now, like, once they do move that, I mean, we'll talk about, maybe become private lenders, maybe buying some businesses, maybe, what other types of wealth creations, can you think of that, that you could share with
Sure. Well, once they become a client of Velocitas Banking, they do have access to myself, the TPF, aka the prophetic financier, and they get access to the wealth of knowledge that I teach in a mentorship program called Empirenomics, where we can show them how to think better, bank better, and of course leverage better, which is basically borrow or invest better. And one of the other vehicles that can be taken advantage of is what we call M2 or M3 types of investments, where a party can get involved in a collateralized asset. We have an underlying mantra that we say that we always give our clients more control, lower risk, and above average returns. And we accomplish that by dealing with collateralized opportunities. And one of them is very simply, which we call a social mobility mobile, is that with this looming amount of debt about to happen in foreclosures, I have extensive relationships with credit unions and mid-sized banks that have certain numbers of debt on their books, and we can buy performing and non-performing assets from them at pennies on the dollar that we can then move those allocational funds into and buy underperforming real estate and then reperform it with multiple ways of modifications or deed and lieu and things of that nature, and create yields up north of 35%, IRR on a normal basis with no risk at all, completely collateralized. And as you mentioned, they're borrowing from their cash value in their policy, but the benefit to this is that you only have to pay back the simple interest. And in most cases, it's 5% simple interest, where the principal is collateralized from the death benefit, which constantly is growing as you make premium payments every year. So you can just exhaust that out years later, never having to pay it back because it's your bank now. You set your amortized schedule of how you want to pay back to yourself. It's in your banking system. So that's one of the examples. Another one could be, I come from the space of mergers and acquisitions. With 10,000 baby boomers retiring every single day and 20% of them having commercial real estate and businesses, we're able to buy small to medium sized enterprises and buy them at a two times leverage or a multiple of their EBITDA, and we're able to buy that. What does that mean in layman terms? We could buy a business from a baby boomer who's 67 or plus, who wants out of the business, and they've been working in their career for 30 years. We can buy that business at 2 times their profit. So example, $1 million revenue company with a 20% marginal profit, that's 200,000. We can buy that business for 400,000. With proper structure and leverage, we can probably get into that deal with 200,000 and their whole paper for 200,000 and look at the ROI on that investment as well. And these are all businesses that are performing. You don't have to start a new business. This is LBO strategies that we use on Wall Street forever. And that's just to mention a few when we do that. So we provide our members and clients a vast knowledge of opportunities that we can empower them to get involved with cash flow, because cash flow is king. Credit, they say credit is queen, cash is king, but leverage is godly.
Yeah, that's right. All right. Well, that's awesome. Again, this is, I'm passionate about this subject. And obviously, we have the key players here, everybody that's involved in how this movement of money works. And in a future episode, I'd love to hear the prophetic financier talk about cryptocurrency and what's going on.
That's a whole nother subject matter that if the general population knows what's going on, they would definitely look for stored value, especially with the debt ceiling that we're in right now here in the US. We need to begin to look at alternative stored values to place our funds. The fiat currency, aka the dollar, is just not has the purchasing power or the valuation that it once had. And the longer you hold it is the less powerful it is. If those who don't know that. Advertised inflation is 2.75%, but minor, already that we've done the studies. It's more like 6 to 8% from a consumer price index. So there's no banks giving you nowhere near 6 to 8% of your money. So that means every dollar that you have banking is a negative compound interest. And this is why 98% of the population retires financially unfit, is because they're not outpacing what we call TO, taxes, interest, inflation, and opportunity cost.
That's right. Well, I can't wait for us to dive into that subject on the next episode. Sure. And that DeFi space, because it's really, if we are going to talk about the truth and equity, we do have to go into that, and we have to talk about that.
And the future of tokenized mortgages. That's another thing that's going to be huge. Real estate's going to be tokenized, and complete mortgages are going to be done on the blockchain as well. So the times are changing. So we need to start looking at those alternatives, and more it's going to be easier to get funding in the DeFi space. That whole credit model that we talked about may be obsolete in another 5 to 7 years, because everything will be on the blockchain and be based on a lot more transparency than just using a third-party credit reporting agency to provide data.
Are you saying that Greg could look forward to a future where he could literally take an application and not have to worry so much about 6 months in underwriting, and he could literally transact in a week, right? In a week's time, and boom, it's like with the smart contracts, right?
That's correct. The smart contract is transparent. There's a lot of crypto on the sidelines looking to deploy capital into great opportunities. And as long as it's collateralized, which the asset will be the tokenized asset, you can fractionally invest, which is great. Think about that, guys. In traditional real estate investing, you can only invest with whole dollars, where in the crypto space, you can be in fractions of a token. So it's a lower hanging fruit, which means more players can get involved, and that creates more liquidity in investments. So I'm excited about it, but for now, I still see how we can help people pivot. And I'm thankful that we're having this general conversation tonight, because we are the players here. We can create a serious movement in the Southeast on a whole and really make history right now, because folks are looking for opportunities. There's over $4 trillion in self-directed IRAs. That's not to even mention how much equity is tied up in homes. Just imagine there's 81 million single family homes in the United States. And 33% of that 81 million are free and clear homes. People literally on free and clear homes. Equity traps with linear appreciation, no leverage, zero. Waiting for probate to take 30% of it when they decease and they transcend. These are harsh times. Folks don't have the access to the education to make informed decisions, and that's what we're all collectively here to talk about.
Yeah, absolutely. And obviously, because we do keep an eye on what's going on, the big guys, Mass Mutual, hundreds of thousands into cryptocurrency, banks creating their own cryptocurrency and all this other stuff. But I know I don't want to get away from the subject at hand today, which was the truth and equity. That's part of it, for the future. Again, I'd like to thank Lauren, the solutionist, for being on here today. I'd like to thank Mr. Al Mills, the prophetic financier, for the great knowledge and financial intelligence, and Greg, our guest speaker today. And if you need to go back and listen to the audio so you can get this information again. But until next time, this has been Minor Ramos, the principal defender with Truth and Equity. Until next time, we'll see you again.